Have you ever wondered why some of the richest people in the world pay surprisingly little in taxes? It sounds unbelievable. You work hard, you earn a salary, and every month a big portion of your income disappears as tax. But billionaires sometimes they pay almost nothing. This isn't a conspiracy theory. This is how the system actually works. And once you understand the rules, you'll realize something shocking. The tax system wasn't really designed for employees. It was designed for investors and business owners. Let's start with the biggest misunderstanding people have about wealth. Most people think rich people make money the same way they do. They imagine billionaires receiving massive paychecks, but that's not how wealth actually works. Most extremely wealthy people don't earn income. They accumulate assets, and this single difference changes everything. Because the tax system mainly taxes income, not wealth. Let's take a simple example. Imagine you earn a salary of $50,000 per year. Your government taxes that income immediately. Before the money even reaches your bank account, tax is already deducted. But now imagine someone owns a company worth $10 billion. Did they earn $10 billion this year? No, that value exists on paper. Their wealth comes from the ownership of assets, not income. And because they didn't technically earn that money as income, the tax system often doesn't apply the same way. This is the first secret. Rich people don't rely on income. They rely on assets, but this is just the beginning. Now here's where the system becomes even more interesting. Let's talk about something called capital gains. If you buy a stock for $100 and later sell it for $200, you made $100 profit. That profit is called a capital gain. And in most countries, capital gains taxes are much lower than income taxes sometimes have, sometimes even less. This means investors are automatically taxed less than workers. But wealthy people take this strategy much further. Instead of selling their assets, they simply hold them. Why? Because taxes only apply when you sell. If the asset keeps growing in value, they can become richer and richer without triggering a tax event. This is known as unrealized gains, and unrealized gains are one of the biggest reasons billionaires appear to pay very little tax. Let's say someone owns shares worth $1 billion. Next year, those shares are worth $1.5 billion. Did they make $500 million? Technically, yes. But since they didn't sell the shares, it's considered unrealized profit. And unrealized profit is usually not taxed. So their wealth increased by $500 million. But their taxable income may still be close to zero. Now here comes the next trick. If rich people don't sell their assets, how do they pay for their lifestyle? How do they buy mansions, yachts, private jets? The answer is surprisingly clever. They borrow money? Yes. Many billionaires live using loans. Let's imagine someone owns $10 billion in stocks. Banks see those assets as extremely safe collateral, so the bank is happy to lend money. If they borrow $100 million using their stock as collateral, they can spend that money however they want. And here's the key point. Loans are not income. And because loans are not income, they are not taxed. This strategy is sometimes called buy, borrow, die. First you buy assets, then you borrow against them. And eventually those assets are passed to heirs. This is how generational wealth is protected, but we're not done yet. There's another powerful advantage wealthy people use. Businesses owning a business changes the entire tax game. When employees earn money, taxes come first, but businesses operate differently. Businesses can deduct expenses. Let's say a company earns $1 million, but they spend $600,000 on operation salaries. Equipment and growth, they are only taxed on the remaining profit. This means business owners can legally reduce taxable income. Even things like travel offices, vehicles, and investments may be considered business expenses. Employees don't have these advantages, and that's why the system often favors business owners. But the biggest advantage might be something most people never think about: timing. Rich people control when taxes happen. Workers cannot if you receive a salary. Tax is automatic, but investors decide when to sell assets. That means they control when tax events happen. Some investors delay taxes for decades, and during those decades, their money continues growing, compounding wealth while taxes are postponed. And when wealth compounds long enough, the difference becomes enormous. This is why many of the richest people in history accumulated massive fortunes, not necessarily because they avoided taxes illegally, but because the system treats capital differently from labor. Now, before we go further, there's something important to understand. Most of these strategies are completely legal. The advanced strategies rich people use to pay less tax. In the first part, we explored a shocking truth. The tax system treats income and assets very differently, and the wealthy take advantage of that difference. But what we discussed was only the surface, because once wealth reaches a certain level, the strategies become far more sophisticated. Let's start with something called tax havens. A tax haven is a country or jurisdiction that offers extremely low taxes, sometimes even zero taxes. Places like the Cayman Islands, Monaco, Bermuda, and others have become famous for this. Now here's the important part. Wealthy individuals and multinational corporations often create companies in these jurisdictions. This is called offshore structuring. Imagine a global company that sells products in many countries. Instead of booking profits in high-tax countries, they move profits to a low-tax country. How? Through intellectual property. For example, a company might register its brand or technology in a tax haven. Then every branch of the company pays royalties to that offshore company. This means profits shift into the low-tax jurisdiction and legally. Taxes shrink. This strategy has been used by some of the biggest corporations in the world. But it doesn't stop there. Another powerful tool used by wealthy individuals is charitable foundations. At first glance, this seems purely philanthropic. And many times it truly is, but it also carries tax advantages. When someone donates large amounts of money to a foundation, that donation can be deducted from taxable income. In some cases, billionaires create private foundations. They donate assets to the foundation, receive tax benefits, and still maintain influence over how the money is distributed. This allows them to support causes they care about, while also reducing taxes. Then there's another strategy called loss harvesting. This one is used heavily by investors. If an investor has investments that lost value, they can sell those assets and record a loss. That loss can offset gains from profitable investments, meaning the investor pays tax only on the net profit. Large portfolios constantly manage gains and losses to optimize taxes. But perhaps the most fascinating strategy involves estate planning. Remember the phrase we mentioned earlier? Buy, borrow, die. The final step happens when wealth is passed to the next generation. In many countries, assets receive something called a step-up in basis when inherited. This means the asset's tax value resets to the market value at the time of inheritance. Let's say someone bought shares for $1 million. Decades later, those shares are worth $100 million. If they sell while alive, taxes apply to the $99 million gain. But if the asset is inherited, the cost basis may reset to $100 million, meaning the huge gain is never taxed. This single rule protects massive generational wealth. And it's one reason why some of the richest families stay wealthy for generations. But even with all these strategies, there's a deeper truth most people miss. The wealthy don't just minimize taxes. They structure their entire financial lives around ownership. Ownership of businesses, ownership of investments, ownership of intellectual property, because ownership creates flexibility, and flexibility creates opportunities, employees, trade time for money. Owners build systems that produce wealth. And the tax code often reflects that difference. Now, this doesn't mean every rich person pays zero taxes.